Hey guys, Freaky Finance here. See behind me, we're getting ready for Halloween. Tony Bones lost his hat. We kind of go all out for Halloween if you remember last year. So, doing that today. We also have quarterly earnings in the middle of earnings season right now. We're going to talk just about a bunch of companies. Start with Rogers, different industries, different themes, and there's a lot of information coming out right now. All of it pretty good. So, let's get into it. So, Rogers, if you remember the Bell Rogers video I did, basically you have this stable business in Canada in telecom industry. But then what happened during COVID is that roaming decelerated, mainly because mobility decelerated. None of us were leaving our homes, so we weren't spending any international roaming charges or any roaming charges in general. And Rogers had a big impact by that. I actually have a pretty big roaming book. And one of the themes that we've been seeing, I just started to see with this latest quarter, is that ARPU is coming back, and the churn hasn't ticked back up yet, which is nice. But anyway, the main idea is that you get this recovery through roaming, and you also get the steady upsell, which 5G will bring as people want to move to more unlimited data plans as 5G is more data intensive. That's kind of the theme. You could say that with Bell or Rogers. Right now we're doing Rogers today because they reported on Thursday, and I saw the ARPU finally tick back up because of roaming, or startup roaming coming back anyway. Throughout the whole period, even like AT&T, we'll talk about them in a second as well. You can see subscribers keep picking up as well, so they're doing a good job attracting more subscribers. And now we're starting to get more per subscriber in revenue dollar, which is exciting. Tried to blow this up as high as I could, but there's a lot of information here on the Rogers revenue side. But really, they have three main business segments, and wireless is the biggest one, then cable, then media. And it is pretty stable. You can see that in terms of EBITDA as well as revenue. So it's a pretty dependable cash flow business. But you can see right here they were able to put out $1 again in earnings per share in a quarter, which isn't bad because the company's around, just call it $60 a share. So that 4 quarters, you're at $4. So it's not bad in terms of PE ratio as well for a company that's still growing pretty good. And I think there's still further room on the upside in the ARPU. And you can see that down here. So there you go. So you can see this is the current quarter that just reported, 51.31. And right before COVID, just to show you, this is Q1 2020. You can see the jump down when roaming stopped and how big of an impact. That's average revenue per user monthly, right? So that's not small because they do have quite a bit of the Canadian population. But you can see we're finally back over 49. We're into the 51s. So that's exciting for me. Freeport also reported on Thursday. Grassberg is pretty much at 100%. They're at 90% at the end of Q3, which is pretty crazy. So again, according to plan, the copper prices remain higher than what we thought they would be when we entered the investment a while back. More details on that Freeport, obviously, in the Freeport video I did a while back. But again, this is kind of like my maintenance that I do every quarter. I kind of go through and, okay, what am I still in? Is it still playing out? What's the current valuation? What does the market think, kind of thing, right? So again, the market I don't think understands how much torque this company has to copper, and this cash flow is just insane in and out, showing up in the balance sheet. So you can see net debt go from 7.6 billion to 2 billion, which is pretty crazy in a year. It's $5.6 billion better in terms of balance sheet. They're originally targeting, I think, only 3 to 5 billion in net debt, top of my head. They're already past their net debt target. So we're going to see some shareholder remuneration here pretty quick, and I'm not sure whether it's going to be in dividends or buybacks. For me personally, I like buybacks here, but I can understand if some people want a dividend. I just would rather own more of their current assets because Grassberg is just amazing, and even some of their American assets are pretty good. Again, just to show what like good is. You can see here revenue going from 9.7 billion to 16.6 billion on the 9 months. More importantly, you can see the torque, right? So you had cost of goods sold going from 6.5 billion to 10.3 billion. So when your revenue goes up by 7 billion, but your cost only goes up by 1.8 billion, you're making some cash. And you can see how small SGA is relative. And we went through that when we did the company relative to the cost of goods sold and revenue. They make a lot of this margin, trickles down to the bottom line. And you can see that here. They're already at, well, you can see the latest quarter was even better. They were at almost $1 in earnings as well in a single quarter, which isn't bad. But again, you look at the miner for the cash flow. I did see this down here that they're starting to pay their employees more in Peru. That's their Peru mine, Cerro Viti. Not a huge amount for this company, but it is something to keep in the back of your head because I noticed Peru and Chile have both been kind of more, they want more from their miners, more from their natural resources. We've seen that theme in other countries. It's just that Peru and Chile are huge for copper. Especially Chile. It's something to keep in your back of your head. There's I mean, it wouldn't be a specific risk for Freeport. It's about a third of their production in Chile and Peru. But for other companies and for copper in general, if something were to happen, copper prices would spike like crazy because there's just so much supply coming from Chile. Up to 50% of free cash flow to shareholders. Yeah, achievement of their net debt target. They already passed that, mainly because, one, they've executed on their production cadence, and two, copper prices have remained so high for so long now. Yeah, it looks really good on the balance sheet, and now we're about to get rewarded finally for it in terms of either a dividend or a cash share buyback, rather. And who knows, maybe it's a special dividend too. They could do a lot of things, but personally, again, I like the buybacks, but that's just me. And then where it is sitting in my investment accounts. And basically, they want to pay us back because they have the cash right now, and they already hit the debt target, but they weren't anticipating to hit their debt target so quickly, so they still have to go to the board meetings and decide how they're gonna pay us, basically, or pay shareholders. It was a pretty good call. Louis Vuitton. So this is a different kind of. So there's certain things that have played out and certain things that haven't. But I still look at the certain companies that are doing well to see what other companies that are in the same industry or similar industry haven't recovered yet. So I look at Louis Vuitton. One for Capri on the fashion side and two for Dufry on the international travel side. Most of you guys are probably aware luxury goods have done quite well, especially in the United States and Asia. Japan and Europe. This is versus 2019 levels, so this is nice with this company. They compare everything to 2019 instead of 2020 because 2020 was such an outlier. But you can see like the business at Louis Vuitton is dramatically better in the United States and Asia after COVID, or during, even at the Delta phase of COVID, I guess. This is Q3, and you can see Europe is starting to come back, but not quite yet. So fashion leather is the main source. You can see 38% organic growth versus 2019 levels. So the wealthy have definitely shifted their spending to goods instead of services. And again, a part of that is because services have been limited for so long during COVID. Like, I know maybe that is services be like experiences kind of thing. So your travel, your cruise ships, your luxury vacations, your luxury shows, all that's been kind of shut down. So all the spending has shifted to the high-end goods, your luxury cars, your luxury fashion, luxury houses. Cosmetics is interesting because it's still just under 2019 levels, so it hasn't fully recovered yet. So there's certain categories that have done quite well during COVID, and certain that have just started to come back. That's what I'm trying to show here. And wine and spirits have been doing well during COVID. A lot of people have started drinking at home more so than what they did pre-COVID. And that showed up in like Diageo's numbers. It showed up in Constellation's numbers. That's why the share price has done so well. Louis Vuitton's done so well too. You can see they're actually ahead of 2019 levels. So certain companies and certain lines have done better than 2019 levels. However, on the selective retail organic side, this is what captures kind of like their Dufry competitors. So their international travel revenue at airports as well hasn't recovered yet, though the gap has been closing. And you can see they're still down 23% versus 2019 levels. And this is exciting for me because Dufry has cut out so much cost that if they can get this to be minus 23%, and there's more in this category than just for Louis Vuitton than duty free, but if Dufry can get this type of, they're going to be cash flow positive, even though this looks really bad, right? You're still 23% short of 2019 levels, but the share price is still a fraction of what it was pre-COVID. So I'm still excited for that. That's why I look at this company right now, as well as the read for Capri. American Airlines also reported this week. The main line here for me is this fund domestic leisure revenue has now returned to pre-pandemic levels at 98% of 2019 levels. Not specific domestic leisure business travel has not returned yet, but domestic leisure revenue has. And if you guys remember the Spirit video, that reads through pretty well. Now Spirit had some issues in Q3, like the airline itself, but this trend is exciting for me because that means domestic leisure revenue and travel has come back, which is where Spirit operates. Though again, you have the oil price impact as well, but when I looked at 2014, it looked like the companies were still doing quite well, even though oil was technically higher for a bit than where it is right now. The Las Vegas Sands also reported this week, so it's been a busy week. I'm trying to go fairly quick here. You can see it was starting to come back after COVID. Macau has like China has a zero tolerance policy, so anytime there's a COVID case, it clamped down very hard. And you can see this here, Q3 was bad, and that's why the share prices have gone back down. One of the things LVS did is they sold their actual Las Vegas locations. So even though they're called Las Vegas Sands, they no longer have operations in Las Vegas. So it's all Macau and Singapore now. So this will be exciting going forward. And the reason why they did that is because the growth rates are much higher in Macau and Singapore than they are in Las Vegas Sands. And they make more money because they're more focused on gambling than on experiences. You can see some things have recovered, some things have not recovered. Gambling at casinos has not recovered. Or gambling at certain casinos has not recovered. It's probably a better way to wrap that. And here you can see I like this chart because they brought back what 2019 would have looked like if they just owned Macau and Singapore locations, and you can see the business is now basically the same. It's about 66% Macau and 34% Singapore if we were in a normal environment based on what they've sold. You can see this here. Las Vegas operating properties are classified as discontinued operations held for sale. And we haven't talked about Las Vegas Sands. I'll probably do a separate video on that. But yeah, the Macau region includes adjusted property EBITDA from the Venetian Macau, the Londoner Macau, the Parisian Macau, Plaza Macau, the Four Seasons Macau, and Sands Macau. And then the Singapore region includes EBITDA from Marina Bay Sands. And Marina Bay Sands is a big, you can see it's 34% of their now 2019 adjusted EBITDA, because they're trying to show us what they're likely to get earnings from in the future. So I thought that was interesting because the first time I saw it, and this is Marina Bay Sands, obviously it's one of the most photographed casinos now. 34% of LVS 2019 EBITDA now anyway. That's exciting, right? So now I'm getting a targeted play in China without having the variable entity issue, technically. But you still have COVID zero tolerance issue. But again, I have the bullish view that eventually the pandemic will be behind us. And Las Vegas Sands, because they've sold the casinos, they have cash on hand to bridge the gap if there is any more gaps between now and the recovery that we should start seeing in the casino. Because again, experiences should start ticking up as we reopen. And here's interesting. So Macau visitation and mass gaming, you can see visitation was down again, the shutdowns. One of the things that's interesting, you can see the revenue's still not great. You can see that even though they're only 18% of visitations, they were still 31% of revenue. Not sure what that means. It could be luxury people have been going to the casinos and spending more money per person that's still going to the casinos. It's interesting anyway, but they're still a fraction of what they were. So definitely Macau gambling has not recovered, and that's why there's still opportunity there in the share price, or at least that's my angle, right? Because I'm still long Belco. And you can see LVS is still around this 38 range, and it's rejected it quite a few times over the years, the last decade anyway. It's an interesting spot for eventual recovery, right? So these ones I dug deeper in. AT&T is one I've constantly wrestled with because I kind of want to get into it. Still, I'm kind of, it looks pretty exciting what they're trying to do. Anyway, AT&T is a cash flow machine in terms of operations. I pointed out when we did the AT&T video that they do have quite a bit of depreciation and amortization. Again, it's non-cash. So when you look at AT&T's earnings, better to look at their cash flow. They are spending quite a bit in terms of capex and acquisitions. So they have the spectrum bids that they're doing. That's adding to debt load. But at the same time, they're trying to peel off non-core assets. So like they're spinning off or splitting off, we don't know yet, HBO going to Discovery, which I think makes a lot of sense strategically for both companies. I'm a big fan of that deal. I just wanted to show that the cash flow is still pretty high. Main thing here to point out is the operating income, as well as the interest expense continues to go down, which is interesting because the debt level has been so high, right? So usually what happened during COVID is a lot of companies that were able to get debt got debt at pretty cheap rates. So a lot of these big companies were able to refinance pretty nicely. AT&T was paying down its debt, though it had to do a spectrum bid, and now it's trying to. There's a lot going on the balance sheet of AT&T in the next bit, and I think they're making some pretty good decisions to try to focus on mobility and fiber and get rid of, or not get rid, but just peel off the business that's not core and let the people that are in the media business run the media business. And I think that makes a lot of sense to compete with Disney Plus and to compete with Netflix as well. Anyway, here's the assets. Again, here I just want to point out the biggest con when we did the video is the debt. And you can see long-term debt still 155 billion. They do have debt maturing 1 year, so current debt at 24 billion. Quite a bit of debt is going on the new merged entity. So the new merged entity gets about 8 billion in EBITDA a year. Times Warner is a cash flow earner, right? It's a pretty good company, pretty good media segment. And Dune released, I think, yesterday or something. So anyway, Matrix is coming in the end of this year. Anyway, one of the things I like that they're doing is that they are really focusing, because again, some of their business segments are in decline. Like Wireline has been in decline for some time on the business side. And what I like is that they are reacting. They're making hard decisions. Like this can't be easy when you're going from 262,000 employees to 214,000 employees, right? And what I look for are these big jumps. And we saw this I shouldn't say every, last 2 years anyway, between June 30 and September 30. Employees shoot down by about 9,000 there, shoot down by about 12,000 here. Not small cuts that they're making. And that's why the business continues to look very good, is that they're reacting to the declining side and they're reinvesting and growing, scaling really, in the wireless side and the cable side, the broadband side rather. So you can see that here in this chart. You can see so their employees keep getting smaller, but they're still growing in the two areas that they need to grow in, which is wireless and fiber. And wireless, kind of like what I talked about, Rogers and Bell will do well with 5G uplift. people upgrade their plans to more data intensive plans, AT&T will make more money off that user. So will the whole industry in general. It's not specific to AT&T. And the same thing with fiber. They're allocating more there because they're making more. As when a person switched to fiber, they're actually making more money off that individual. And they are still growing their net ads, so they're constantly growing each year. Even though the share price has gone down, so the business has gotten better. And I expect at some point the ARPU will get better. But so far, America, so this company, AT&T, hasn't had that influx up in ARPU yet, which is interesting. And then HBO Max is interesting. So they were growing domestically, and then what happened is that they discontinued their Amazon Prime wholesale partnership. So that hurt their domestic HBO for this quarter. But then their international picked up because they did pretty good in Latin America, about 4 million subs in a quarter, which isn't bad. So the net effect was about 2 million subs in the quarter, which was a decel. So maybe that explains some of the weakness there for HBO because they are starting to spend more. But again, the production slate was pretty heavy for Q4 versus Q3. So we'll have to see what Dune brings for the company and The Matrix and a couple other things. I think Succession's back on. Here, I just wanted to point out the EBITDA under pressure at the Warner Media side business. Again, that's due to spending. They are spending quite a bit on marketing on HBO to get the subs. And I think this is going to continue to accelerate into the deal with Discovery. And if you think on paper, the Discovery deal makes a lot of sense because you get the HBO, which is kind of like the higher cost eyeballs, more chance to go viral, right? And you get more people interested. So you get this kind of spike in subs. And then the idea with Discovery is that you get this steady, cheaper content. Not cheaper is a bad term, but just cheaper to make content. Like daily live TV content, right? Every day that people stick to. So you get the spike to get the people in, and then you get the steady library of consistent content with Discovery. That's not to say HBO doesn't also have some, but it's kind of how I view it. Anyway, that's why I like the deal. That's why I'm still looking at the company, and the deal just keeps getting cheaper, right? So it's starting to look really good on paper. One of the things that's interesting is that the consumer wireline, this is their broadband, has finally stopped declining because they've won the existing wireline business. The legacy business has declined so much that it's the declines are being offset completely by the fiber expansion. We're starting to see this line finally stop declining, which is nice. You look at the revenue. So if anyone were to look at the income statement revenue for AT&T, you'd see a decline in revenue. But again, it's the other column because of Dish TV. So they finally took that out of there. And they weren't making good money on corporate. And here's the fiber. What I was talking about, why they're trying to push fiber so much, is they get more in broadband ARPU. So more people go up fiber. You see this here going from, and this is pretty linearly up, which is nice to see, right? You're going from 51 to 55. It's small for per user per month. So you can see why they're pushing fiber. It has pretty good economics. And again, this is during a time when their employee count continues to decline. So the underlying business continues to improve in terms of scalability because subcount's still growing on the wireless side. And now you're getting ARPU growing on the consumer broadband side. So again, I'm still looking for ARPU expansion on the wireless side. And here's the HBO. This is kind of how I look at the subs, right? So one of the things I always look at now, because I saw what happened to Disney Plus, is when they really accelerated their international sub count, the share price responded dramatically well. But the ARPU shot down quite a bit because a lot of their subs were from India initially, and still are. And so anyway, the ARPU wasn't great, but for HBO, the ARPU is actually pretty high. They make 11.8 still. One of the things I want to look at this quarter is because I saw international shoot up because they relied on Latin America expansion this quarter. I wanted to see what the hit to the ARPU was, but it wasn't bad. So that means they're not, at least, like it is lower. So that tells you that Latin Americans are paying less than US in terms of US dollars, which makes sense. The cost of living is way different down there. Disney's around $420 per user, whereas HBO is making $11.80 per user a month. Higher price point. All right. And again, here's the HBO wholesale. One of the reasons for the decel, is the main reason for the decel. You can see actually decreased by 2.4 million subs in an industry that's growing. So it's the power of Amazon. So they decided to discontinue off there and do their own thing without the partnership with Amazon. That's what this is. So short term, a decel on HBO, but again, longer term, probably a non-event. And again, this theme is something similar. Like we saw this with Netflix, like Disney pulled the shows off Netflix. The content creators are deciding to do their own distribution. So some of these partnerships are starting to get frayed, right? So we'll have to see what the response is, like what Amazon's response is. I mean, media is pretty small for Amazon. Apple, again, pretty small, but Apple's churn's pretty high. Maybe they try to take over one of these companies for cheap using their share price as a currency. That was always kind of an angle, a backseat angle. But again, this industry is going to go under more consolidation than what it already is, I think. All right. We talked about that. Talked about DirecTV. Oh, I didn't talk about the cost savings. So they are doing. Well, I kind of did through the employee count, but you can see here clear line of sight to achieve 6 billion in cost savings run rate by the end of this year. Half of our 6 billion, so 3 billion. They flag 1 billion from streamlining our field operations. A similar level of savings made from our procurement processes. That's pretty crazy, right? So one angle that's good, finding the inefficiencies, but how long are these inefficiencies here? Because that's $1 billion in just purchasing procurement process savings. So anyway, they are starting to really manage this company, and I think eventually it's going to start showing up in the share price. But I have to figure out when I want to start getting in because it looks really good, right? Get in before the deal, or do I just want to buy Discovery and just get the new merged entity through Discovery? Because they're both very cheap. Discovery is also a fraction of what it's probably worth at some point in the future. The market really doesn't believe these companies are going to make it in terms of an online independent streaming platform. And 0.5 billion savings, so 500 million from rationalization of a retail store footprint. Usually that means reducing the storefronts, which are usually not cost effective, right? And again, it's just another way to scale. Probably just reduce the amount of stores that they have, especially the weaker stores. I like all those moves. I've talked about that already. Yeah, they talk about reaching 70 million global subs, but again, I kind of went through it and said it was kind of more mixed than just raw 70 million. But yeah, it is growing. This is talking about the deal. For me, I want to decide where I should buy AT&T because I don't own it. It's like, should I own it in my RSP, TFSA, right? Because I'm Canadian, or should I just own it in the taxable? And this will depend. Their decision here will depend on where I want to own it. So far, they haven't actually decided, which is kind of frustrating because the deal, I'd rather know before the end of this year, but they basically said they're not going to know until the early part of next year. Lots to think about. Anyway, Intel quarterly results are actually pretty good in terms of cash flow, but there is a strategic shift going on, and not a small one either. Some points of strength for Mobileye and kind of things are up pretty good. We knew Mobileye was going to start doing good, and I think that trend is just going to continue. The analyst asked Intel about Mobileye 0 times on the call, which is par for the course. But I did want to finish with Intel, but I don't think I have time. I tend to, once I start talking and going through things, I tend to take longer when I think I will. But yeah, there's a lot of companies out there that are starting to get pretty cheap. Intel would be one, but there is an investment cycle that if you're an investor, you have to own it for probably another 2 years of pain and lack of growth to get an accelerated growth in the back half. But I mean, technically the company is still a cash flow machine, though its free cash flow will be reduced by its higher capex spending, which will also increase depreciation, which will therein decrease earnings per share. So while it screens at about 10 times earnings, which is dirt cheap in this kind of environment, it could technically be trading at 12 times future earnings for a bit until they reaccelerate. What I mean by that is that the expenses will increase in the next bit. And we saw that with Pat hiring 6,000 more engineers. I'll probably go more in detail about that at some point, and I'll probably do a separate video on Intel because there's just so much to go into, and it's starting to get pretty interesting again at these prices.